Hi everyone, and welcome to our channel where you'll learn everything about money, saving, investing, and retirement. We're kicking off Student Loan Month at Diamond Nest Egg. With interest rates at an all-time low, you're probably wondering if now is a good time to refinance those student loans and to lower your monthly payments. Watch this video to make sure you avoid the most common mistakes when it comes to refinancing your private and federal student loans. Making these mistakes could cost you tens of hundreds of thousands of dollars over the lifetime of your student loans. For those of you that are new to Diamond Nest Egg, I'm Jennifer, money coach, personal finance educator, and student loan guru to Gen Zers and millennials. Student loan debt has reached another new high of nearly $1.7 trillion at the time of this taping. So it's no surprise then that every single one of our coaching clients has student loan debt, and a lot of it. On average, our coaching clients have over $200,000 in student loan debt. So trust me when I tell you, these are the student loan refinancing mistakes you do not want to make. I'd love to know how much student loan debt you have. Let us know in the comments below. So what's the very first big mistake you should avoid when thinking about refinancing your student loans? It's not understanding which of your loans are federal student loans versus private loans. Federal loans come with certain benefits that go away when you refinance them with private lenders. And yes, when you refinance, you must do this with a private lender. The first federal student loan benefit you forfeit when you refinance with a private lender is any current or future interest and payment moratoriums. So for example, if you had refinanced your federal student loans in 2019, when the pandemic hit and the government suspended interest accrual and payment requirements this year on federal student loans, you would not have been able to take advantage of these interest and payment waivers. The second federal student loan advantage you forgo when you refinance with a private lender is the flexibility in repayment options. These include graduated repayment plans, extended repayment plans, and most importantly, income-driven repayment plans, which can lower your monthly payments significantly if you don't earn a lot of money. These repayment plans base your monthly payments on your income and family size and forgive your remaining debt after 20 or 25 years of repayment. The moment you refinance your federal student loans with a private lender, these flexible repayment options disappear. The third benefit you give up when you refinance your federal student loans with a private lender is the option of interest-free payment postponements. If you go back to school, lose your job, or run into financial issues, you may be able to temporarily pause repayment by deferment and forbearance. If any of the terms so far sound confusing, don't worry. As I mentioned, it's student loan month here, and we'll be going through all of this in the next few weeks. The fourth reason for hanging on to these federal student loans, and probably the most important reason for those of you teaching or working in the public sector or for a nonprofit, is this: you will lose access to the federal public service loan forgiveness and teacher loan forgiveness programs, which forgive your loans tax-free. This option goes away immediately when you refinance with a private lender. So before you go ahead and refinance your federal student loans, ask yourself this: am I willing to give up all these benefits? What if something bad happens to me and my job one day? Will I want to take advantage of these income-based repayment plans or deferment or forbearance options? What if next year I decide to go work for a nonprofit? I won't be able to apply for public service loan forgiveness. Am I okay with that? I've seen clients in tears as well as in anger because they didn't thoroughly understand all the benefits they had given up by refinancing their federal student loans for a slightly lower interest rate. You can't reverse this. So consider these questions carefully. And if the answer is no, you're not willing to give up all these federal student loan benefits, do not make the mistake of refinancing your federal student loans with a private lender. I'm curious how many of you here are on an income-based repayment plan and how many are working towards public service loan forgiveness. Pop your comments below and let us know. Once you've made the decision to refinance with a private lender, the second big mistake you need to avoid is not understanding the factors that these private lenders will use to determine if they will approve you for the refinancing. In order to get approved, here's what you need. The first thing is a steady job or consistent income. Most of our clients refinance their loans via Earnest. I've included the link for Earnest below this video, but we'll be doing a separate video on the different lenders shortly, so stay tuned. Back to Earnest. Your lender needs assurance that you'll be able to make your monthly payments without issue. So you need to show them that you have a steady job or source of income. Some lenders will even require a certain amount of savings before they approve you for the refinancing. The second factor that private lenders like Earnest will use to determine if they will approve you for the refinancing is your credit score. You need a minimum credit score range between 650 to 680. The higher your credit score, the lower the interest rate that you'll likely get. Borrowers that are approved for student loan refinancing often have credit scores in the high 700s. So if your credit score is below this, you may still be able to get an approval if you apply with a cosigner. The third thing that private lenders like Earnest want you to have before they approve you for refinancing is a debt to income ratio, or DTI, of generally 50% or less. Here is an illustration to show you how to calculate your DTI. Your DTI is a sum of all your monthly debt payments, such as your student loan payment, rent or mortgage, car payment, and credit card and personal loan payments, divided by your gross monthly income. Your gross monthly income is the money you have earned before your taxes and other deductions are taken out. So as you see from this example, if your monthly debt payments are $3,000 and your gross monthly income is $5,000, then your debt to income ratio, your DTI, is 60%. This means you would most likely not get your refinancing approved because your DTI is higher than 50%. If this is you, take a look at the video here. It'll walk you through the money habits that are hurting you and how to change them so you can bring your DTI down and improve your financial situation. Moving on now to the third mistake that folks in the refinancing process make, and that's going into this without knowing how much you can afford to pay each month. If this sounds like it could be you, grab our financial guide below to get your budgeting template and figure out how much you have left over at the end of each month for your student loan repayments. Once you know how much you can afford each month to pay for your student loans, it's time to do some shopping, but not the Amazon con. This is the fourth mistake that folks make in the student loan refinancing process. You'd never buy a car or a house without shopping around first. And it's the same for your student loan refinancing. As I mentioned, most of our clients refinance via Earnest because they get the best rates given the higher credit score that we've helped them attain. Earnest also takes into account your emergency fund savings and your retirement savings. Most other lenders ignore these factors. If you don't have an emergency fund or are looking to boost it up a bit, check out our emergency fund series right here. We go through what an emergency fund is, the exact amount you should have, how to start growing it, as well as where to best keep it. Returning to refinancing, the other reason we love working with Earnest is that it allows a lot of flexibility when it comes to choosing their repayment length. You can choose a customized repayment length between 5 and 20 years, whereas most other lenders will force you to pick between a 5, 7, 10, 15, or 20-year loan. In the description below, you'll find the Earnest link if you want to start checking your rates. It only takes 2 minutes and it won't hurt your credit score. So here's the big fifth mistake when refinancing your student loan debt, and that's extending the payment period. Say that you currently have $100,000 of student loan debt at 5% and you're on a 10-year student loan repayment plan. Your monthly payment would be about $1,060. If you refinance your $100,000 of student loan debt at 4.25% or 0.75% less than what you're currently paying, but extended the repayment period from 10 years to 15 years, your monthly payment would go down from about $1,060 per month to $740. That's a lot of monthly savings, which sounds great, but because you're now paying your loan off In 15 years instead of 10, you actually end up paying significantly more in interest, close to $6,000 more, in fact. So don't make this mistake just because you see the lower monthly payment number. You're paying more in the long run, and sometimes a lot more, as we've seen from the example I just gave you. So please try to keep the repayment period the same. If it's going to take you 10 years to pay off your current student loans, then refinance for 10 years, not any longer. So to recap, these are the 5 big mistakes you need to avoid when refinancing your student loans. First, not understanding which of your loans are federal student loans versus private loans. Ask yourself if you are prepared to give up all the benefits that your federal student loans offer. Second, not knowing the factors that private lenders will use to determine if you will be approved for the refinancing. These factors include your income stability, credit score, and debt-to-income ratio. Third, not calculating how much you can afford to pay towards your student loans each month. Remember to download the free reopening guide below and look for that budgeting template so you can figure this amount out. Fourth, not shopping around to see what the different private lenders have to offer. We all date before we get married. It's the same when you're looking for lenders to refinance with. Date them before you decide. Fifth, refinancing over a longer period of time. Just don't do it. If you're currently on a 10-year plan, refinance to a 10-year plan. Or shorter if you're ambitious and think you and your finances can handle it. Just don't go longer. You'll end up paying more in interest in most cases. Well, that was a lot of information, I'm sure. If you enjoyed this video, give us a thumbs up and hit the subscribe button. You'll be notified immediately when we post the next video in our student loan series next week. In the meantime, check out the other money-saving, wealth-building videos on this channel. Drop us a line if there are any particular topics you'd like us to talk about, and have a great week.